Hey traders, Nick here. Wanted to look at the big picture opportunity that is almost here that could develop this week, as soon as this week I should say. So the big picture is these are weekly candles. So we're looking at the S&P here. You can see we've had quite a good run. So that's the fear number one. Okay, have we gone too far too fast? This is the NASDAQ, and this is kind of today's opportunity, and it basically lies right here. You can see that the NASDAQ is kind of approaching a level where it's failed before, and usually the market will fight it out, and if the bears prevail, then we dip. How far is a different conversation. Today I'm talking about what if we don't dip, and what if the bulls prevail. So usually if we get a boost of something, headline, whatever, positive development, we might be able to break it. And if they do break it, then they're going to extend the overshoot to the upside. Now, similar opportunity in the small caps versus this candle right here, which was very pivotal, and the fact that it's thin in the middle like this is shows indecision, and they thought they didn't know what they wanted to do at that time. These are weeks again, and then we went into the Christmas debacle. So all of them look kind of the same. This is the Dow here, but I want to concentrate on the NASDAQ just because it has the biggest, those mega caps that actually trade in unison, FANG, etc. It might make it easier to do. I don't know. We shall see. So here is today's opportunity. So this is the NASDAQ NQ. So the minis, you can think about it as the NDX-ish. And that's the area where we are challenging right now. And this is the Friday, the last close, or the Friday trades on the 15th. Versus the fails on December 3rd, which was pretty important, which is just above current levels. And also the kind of island fail right here, which is in November, early November. So every 30 days we had a dizzy. If I eyeball it, this probably would have been a month earlier, early October. So there is going to be a fight. What happens there, I don't know. So how do I play this? I can use the QQQ, which is the ETF, or the NDX, which is the index. So you can see I've drawn several lines because every time we come to a point where I think we're going to battle it out, I draw it. So if you look at this turquoise one right there, these are daily candles, I believe. Yep, one day. This turquoise right here, you can see it's priced out, almost all of it. And it almost priced it out perfectly. You know, I said it would burst, it would dip, and burst a little bit more, dip. These are not, I picked these levels on purpose because I look left and my best estimate of it, and they have been pretty accurate. And then the green one came into play at these levels right here, and this is now what I'm saying. Okay, we have a similar one here coming together. So we started with the blue, then the green. The green one has more legs into it, but that doesn't mean they don't falter along the way. And now the white one comes into play, and this is kind of where do you draw the line, right? So I think that the last point of failure on the Qs was that day right here, which is December 3rd. So I'm going to look at that point in time and say, okay, this would be the candle I'm battling to see if they can get to this point. And once they're done with this, can they get to this point on this side? All right, so how do I do it? I take longs in the QQQ, that's one way, or in the NDX, and I hope for the best. But the way I take longs differ from person to person. Some people like to buy. I can buy the Qs itself at $171 per share and hold it. I can buy calls or call spreads and hold it, or I can sell put spreads. I don't sell puts naked in the indices. So that would be one way, 3 different ways of doing it, actually 4. So, and as far as calls, I would use March or longer. I don't want to run out of time. I don't want to be correct and run out of time. They cost more to buy in March, but if I'm buying a spread, it doesn't cost more. The spreads are the same near the money, whether now or a month from now or a year from now. They're going to cost about 50% of the width. So where do I place my risk? I like to place it close to current price, one way. This way, I only have to guess the direction. I don't have to how far. What does that mean? Okay, so if I guess, okay, it's going to move up, and I bought calls and call spreads close to where it is right now, I don't have to guess how far up it has to move for me to make money. Whereas if I buy the hope up here and it moves up and it falls short of me, I may lose money anyway. So you remove one variable. And as far as if I'm selling put spreads, I can do them for next week, this week if I'm active trader, or the week after, or out a month. And then where do I sell the risk differs. So for that details, you can email me and I'll give you details. I'll try to share it in a write-up maybe. But that I wanted to convey the concept. We are at perhaps a line that we need to cross, and I'm going to draw it. I'm going to say it's the battle of December 3rd, the December 3rd battle. So I'm going to show you the same chart in the NDX, less noise. I don't chart a lot on this one. That's the December 3rd candle, I bet. There you go. This is where we're at as of Friday, and this is the NDX, the NASDAQ index. This is the upside potential. If we get there, there will be stops along the way, and the stops will be one here, one somewhere around here, and then this will be a major battle up here if we get there. So the only problem is that we have come so far so fast, so we will have challenges. But there's nothing wrong with doing this to get there. So it's not going to be straight shot to the moon. So where do I put my stops? So if I do it with the QQQ, I'm going to go there. I'm going to go granular, meaning smaller periods of time. I'm going to go 60. Okay. So this is 1 hour candles versus daily. Come on, chart. Cooperate. There we go. This was the high last week. This was the low. So if I wanted to place if I'm not long the Qs and I want to go along the Qs, what do? Pay attention to how I would do it. I would go long it above this level. I'm going to eyeball it, whatever, 172.5, 4, something like that. Once they break above this candle, they will probably trigger machines buying. If they lose this level, that's one level to watch. If they lose this level, this should be some support short term. Now, if they lose this candle, I probably want to stop myself out. So if I buy calls and they go below this line, I'll say, you know what, they didn't work this time, I'll try it next time. Because there's a gap down here, they probably want to close it. It does have support. If they lose this one, I'll probably get out. If I'm still not out. If I lose this one, I should be out by now on the short-term trade. These are short-term trades, okay? So trigger, caution, out 1, out 2, out 3. Depends on the people's preference. I like to sell the risk, and instead of buying up, I sell down here somewhere. And if you want specifics, you can message me, and I'll try to share them in the write-ups. If I haven't done so already, I can't remember now. This week. So you can do both. I can sell the puts, buy the calls. There are many other ways of doing it by doing call spreads. I mean, the spread regular or the spread calendar, spread diagonal. I've shared these before. Anyway, the video is getting longer than I wanted. Just wanted to point out that there is an opportunity. It's in play soon, if not already. Here's the S&P. If I go to daily, you'll see that it's in play as well. And the S&P probably will work against us because they're already up so high. So I shared this upside potential right there. And look how the price unfolded. Almost exactly to where we said it would. Where do they stop? Here? That's probably December 3rd and 4th. So same candles come into battle here. December 4th candle, December 3rd and 4th area. Nick signing out. If you have any questions, let me know.